Q1 has been riddled with market uncertainty and volatility, especially with the announcement of a more targeted auto tariff approach set to take effect on April 2nd. We break down how investors can hedge against market swings. First up, Peter Harrell, non-resident fellow at the Carnegie Endowment for International Peace, joins us to discuss the implications of the new tariff plan.
U.S. stock futures pushing higher today on reports that the Trump administration's coming wave of tariffs will be more targeted than the barrage that the president has occasionally threatened. According to reporting from Bloomberg and the Wall Street Journal, it's a sign of relief for markets gripped by this anxiety, crippled in some cases, and you can merge the two words together if you'd like to, like I did. But ultimately, that anxiety has knocked around Wall Street because of the threat of an all-out tariff war. Joining us now to discuss how this will all play out, we've got Peter Harrell, who is a non-resident fellow at the Carnegie Endowment for the International Peace. He previously served as Senior Director for International Economics and Competitiveness in the National Security Council during the Biden administration. Great to have you here with us this morning. So, this is what we had been discussing, and the mindset around the Trump administration potentially being more targeted than just wide-ranging and sweeping tariffs. How should we be thinking about this now going forward, and for what CEOs have been trying to do and making sure that they're clear of some of the tariffs that are coming forward?
Well, thanks for having me on this morning. I keep two things in mind when I think about the Trump administration and tariffs. First being, as we've seen over the last 2 months, nothing's final till the president says it's final. So we're clearly seeing a shift in tone out of administration officials speaking to the press, out of administration officials you talk to privately. But I do think we have to keep in mind nothing's going to be final until April 2nd, when the president actually rolls it out. With that big caveat, we do see some evidence that at least the cabinet, at least the senior members of the administration around the president, are now planning for a somewhat narrower set of tariffs on April 2nd than we had been hearing about a couple of weeks ago. Though it's important to understand that this is still a quite broad set of tariffs, just not as kind of spectacularly broad as it could have been a couple of weeks ago. I think we see two big changes, again, in terms of the messaging coming out of the administration. So the first thing is they're talking about imposing these quote unquote reciprocal tariffs only on a subset of America's trading partners. Now, these are going to be America's biggest trading partners. They're talking about doing it on, countries like Vietnam, on some of the European countries that are our biggest trading partners. So while it will be a subset of our trading partners, it will be a large share of trade. The other thing, two important things they're talking about is it looks like the potential rate might be a little bit lower than the sort of 25-30% some of us had been thinking a couple of weeks ago. So we might be seeing a somewhat lower rate. And then they're making clear that they will not, at least for now, probably be stacking sectoral tariffs on top of these reciprocal tariffs. And just to briefly give a sense of what that means, if you have stacked tariffs and you have a 25% metal tariff and a 20% reciprocal tariff, that's actually a 45% tariff. And they're now talking about putting that on hold, but still expecting some big announcements on April 2.
Who is behind these headlines that we're getting on tariff changes from the White House, Peter? And I ask because I think it's important for investors to know whether President Trump actually does care what the market's doing and therefore is walking back his tariff policies behind closed doors, or if this is just the economic side of the White House trying to appease the market and this is kind of much ado about nothing.
I think this is the big question. I mean, just in the last couple of days, we've definitely seen National Economic Council Director Hassett. We've seen Treasury Secretary Bessent all talk about the narrower scope. We've also seen some information that I think has been attributed to Secretary Lutnick over at Commerce, who, of course, has been a major hawk within the administration. So we're definitely seeing this out of multiple points in the cabinet. That said, I think you are making exactly the right point. We don't know that this is going to be narrower until we actually see what the president says. And I use the the Canada and Mexico tariffs as an example, where some of the economic side of the house had not wanted 25% tariffs on Canada and Mexico. Trump brought them into force. There was a bad market reaction. They then pulled back. So I think the market is resonating, but whether it has really gotten through to the president himself, I think remains a bit TBD.
How much do you think globalization is baked into so many companies' valuations and growth as it specifically relates as well to the U.S. growth in itself? As we think about how these companies contribute to GDP, that's a larger consideration if we're now cutting off some of those larger globalization efforts of the past.
Yeah, so clearly, the president campaigned on an anti-globalization agenda and on, as he puts it, an America First agenda. So it's not surprising to see this playing out. That said, I do think, as you say, when we look at these sweeping tariffs, there are ways in which these sweeping tariffs actually undermine efforts to rebuild American manufacturing. If you have 15, 20% tariffs on auto parts that then are going into autos that are being assembled in the United States, that's actually increasing the cost of building autos here in the US. Another example that I think the administration is going to have to grapple with, the tools to make computer chips, semiconductor manufacturing tools, a lot of them are made in Europe and in Japan. And they cost like $100 million a piece. And so if you put a 25% tariff on that, you're actually going to increase the cost of making computer chips here in the United States. So I think they really need to grapple with, is this really broad approach to tariffs the right way to accomplish their objective of rebuilding manufacturing? Or should we have something a bit more targeted? One final point, because you talked about earnings. Look, I think big U.S. corporates have a low tariff environment heavily baked into their earnings earnings estimates. One estimate I saw a couple of weeks ago, before we've gotten these narrower reports, but the initial kind of reports of 25% reciprocal tariffs on pretty much everyone could have been a 16% hit to S&P 500 earnings this year, because that would be the cost of actually paying the tariff. So I think there are some real potential earnings implications here for companies that are dependent on imports.
Peter, great to see you this morning. Thanks so much for taking the time with us.
Next, find out why Fernando Valle, hedge energy analyst, expects copper prices to accelerate. Copper prices surged following reports of a potential new copper tariff. Fernando Valle, hedge energy analyst, joins us to share why he remains bullish on the metal.
U.S. tariffs on copper imports could be coming within weeks, according to reporting from Bloomberg. Copper traded in New York surged to a record. On the report, President Trump previously ordered an investigation into potential tariffs on the metal to be resolved within 270 days. It now appears the report may be coming much sooner. Joining us to discuss, Fernando Valle, hedge energy analyst. Fernando, thank you so much for joining us here. I want to pull up a chart if we can, just taking a look at copper prices stateside, hitting a record here, outperforming copper prices on the London Metal Exchange. I wonder where you see New York copper prices going, particularly given just the shift that we've seen in metals prices and kind of the impact of tariff prices on precious metals like copper.
Well, we've been bullish on copper despite what we define as a Quad 4 environment in the U.S., which is essentially what we're having, inflation accelerating and just lower growth. So the reason for that is exactly what you mentioned. Is we think copper will follow a similar trend to what steel has done, which is ramp on the back of tariffs. The big issue that we see is that on our trading ranges is getting close to the top of the range. And so there might be some limited room here to grow. We think that that's already a little bit front run as it goes. But the one thing that I'll caveat that is we're expecting to see a large stimuli from Europe and China specifically, which has been the largest buyer of copper, and that could be a significant impact, positive impact, even after the tariffs.
So to what extent do you think we're nearing a top with copper, given the multitude of factors that you just laid out?
So in the near term, it's at the top of our range, so we think we're coming close to that near term peak.
Got it. And I wonder how you're thinking about just the shift in metals prices overall and how big an impact that could have on the prices of other, goods that obviously these metals are put into in the United States in particular. How should we be thinking about the impact that this lift in copper prices could be having just on everyday products?
So the near term, the biggest copper goes primarily into the construction side in the U.S. We are already seeing it. We've seen a slowdown there on the overall construction. So we aren't expecting to see again a huge impact near term. The biggest factor for us has been the slowdown from the economy itself. Obviously, you've had deflationary measures with Doge and others cutting some of that consumption. So when it comes into April, we expect to see a little bit more of an acceleration where we get incrementally more positive. But in the near term, we've seen more. We've been very bearish on U.S. consumption. We've actually seen capital flows going outside the U.S., as I mentioned, to Europe and Asia, where you're getting more stimuli and potentially recovery from what has been a very dire previous period.
Fernando, with the strength in China and the pivot for them to increase their economic growth, they're putting lots of orders in and buying lots of copper. They're one of the biggest importers of copper in the world. But with supply imbalances the way they are right now, are they willing to pay these high dollar prices for copper just to keep their economy going? And if their supply imbalances continue, we could see lower prices for copper down the road. This is what you're pointing towards as far as a peak in prices for copper?
Yeah, and more in the near term has been the U.S. demand side being weaker because, as we said, that Quad 4 is biting right now. As you mentioned, China, I think the stimuli is because their economy is struggling, and so they are going to try to increase demand. Is the same thing that we've said on the natural gas side, with the caveat that natural gas has already been strong because of the inclement weather in the northern hemisphere over the winter. We think there's going to be an increase in demand because Europe and China are stimulating their economies, whereas the U.S. has been trying to contract or at least trying to reduce some of the deficit with, again, acts like Doge and others trying to curtail some demand, and then just the effect of prices itself. Going into April, we see an acceleration in overall demand, and that could be positive for copper.
I want to switch gears a bit, Fernando, and talk to you about oil. Obviously, a lot of headlines impacting oil right now, but I specifically want to talk to you about this idea that we may be moving towards a ceasefire between Russia and Ukraine. I first of all wonder if you buy that idea that we are moving towards a ceasefire, but also to what extent you think the end of this war could impact oil prices, if at all, just given the fact that we do know that China and India have been purchasing oil from Russia this whole time.
Yeah, as you said, there's very limited impact on the overall supply of crude. In fact, crude itself could decrease because one of the areas that Ukraine has attacked in the near term has been refineries and other infrastructure within Russia. So there may be fewer crude exports and more refined product exports from Russia if there is a ceasefire. As far as the likelihood of a ceasefire, I'm an oil guy, and my geopolitics are not as strong, but I take everything with a grain of salt. Covering energy for 15 years, you've seen that governments come and go on their promises. I think the overall impact on the oil side, again, the stimuli in these economies would be a much bigger driver than the supply chain because, again, as you said, that oil is already getting to the market. If anything, it helps reduce some of the differential prices between Russian crude and others, increases the competition. So it could be bad, for example, for WTI versus Brent, but not necessarily for the overall Brent price.
Well, we always appreciate your geopolitical takes, Fernando. Thank you so much for joining us this morning. Appreciate it.
Thank you.
Coming up, Greg Migliore, Auto Guide's editorial director, breaks down the winners and losers of the Trump administration's 25% tariff on imported cars. Looking to capitalize on Trump's auto tariff, Greg Migliore, Auto Guide's editorial director, shares insights on potential opportunities for both investors and consumers.
Shares of U.S. and international automakers moving to the downside after President Trump's announcement of 25% tariffs on all cars imported into the U.S. and some auto parts starting next week. So, who are on the winners and losers list of the trade war here? Joining us now to break it all down, Greg Migliore, Auto Guide Editorial Director here. Greg, great to have you here with us to help us really parse through what we do and what we don't know at this juncture. But let's just start with your assessment of some of the winners and losers on kind of both sides of the column here.
Hey, good morning, Brad. Thanks for having me. It's kind of a complicated situation because no vehicle, I think, is entirely American-made or fully imported. You know, parts are sourced. It's a global economy. They're sourced from all over. So you look at the companies that are best positioned to perhaps weather this out, and that's Tesla, likely. You've got the Detroit Three, Ford, General Motors, and Stellantis are in better positions, but I think it's also fairly inconvenient for them because while they do rely on their U.S. footprint, they also have many factories in Canada and Mexico. I think of those three, Ford is probably relies most on U.S. production though, so they're going to come out a little bit better right now. And then you kind of break it down into the different international automakers. Honda is in pretty good shape, actually. They make a fair amount of their vehicles in the U.S. Toyota, it's a little bit of a mixed bag. The Tacoma comes from Mexico, so that could be subject to tariffs. On the other hand, the Tundra is built in Texas. The Toyota Camry, top seller, built in Kentucky. So it's a bit of a mixed bag for them. And then you have companies like BMW and Mercedes that do have factories in the South, in the American South, the Southeast, but they don't have nearly as much production here as some of the others. So their exposure is going to be greater. And it's, I think at the end of the day, you put consumers also in the bucket of perhaps people who will be most affected, perhaps losers, because most likely, we're going to see price increases, $5,000 to maybe $12,000 increases, depending on the vehicle and perhaps, how severely they're impacted.
Greg, let's pause there for our viewers who are not just investors, but also everyday consumers. Help us understand where consumers who are in the unfortunate position of needing to buy a car at the moment would potentially see the biggest price increases. Are used cars going to potentially increase as well? We've already seen this record run up in the consumer price index when it comes to new cars. How should consumers be thinking about where they might be able to find some opportunity?
So right now, I think if you're in the market, you really want to just have your head almost like on a swivel. I think you want to be aggressive. I think you want to look at used cars because I think while the intent of the tariffs is to try to, increase production in the United States, what's going to happen is used car prices are going to go up. Just it's a supply and demand, simple economics issue. So used car prices are going to go up. You're going to want to probably do as good as you can to try to get a good loan if that's what you're looking to do to finance your new vehicle or your used vehicle. And it just makes the car buying process much more complicated. Now, I think you might see dealers maybe a little more willing to deal because they know their situation, after April 2nd is going to get more and more complicated. So perhaps, in the next couple days, even this weekend, you might want to try to really get in there and see what you can do as far as perhaps getting a newer used car because complicated is just underselling it because right now we know what vehicles and what companies will be affected, but then you start to drill down deeper and it's like even Teslas are only about 80% made in the United States. The Ford Mustang is about 80% US parts because not every single part is built in the US. So it's going to be quite complicated.
And so, Greg, all this in mind, what season of vehicles, because as we know, typically some of the 2026 vehicles would make it onto dealership lots and whatnot by late summer, early fall. So it sounds like, is this a current this year problem or a next year's vehicles that are in production right now type of problem?
Oh, it will be immediately for this year because the car companies, they have to follow the law. So they're going to have to figure out how to apply the tariffs and how to break down which ones may or may not be subject to the U.S., Canada, Mexico agreement, which was passed in 2020 by the first Trump administration. So they need to kind of parse all of that out. But after, April 2nd, it's, we're going live, these things are going to happen. So it's going to be an immediate impact for consumers and for automakers.
Greg, 30 seconds here. I want to talk about Tesla before we let you go. Elon Musk saying the cost impact on Teslas is not trivial when it comes to tariffs, breaking his 3-year streak of not posting about tariffs on X. How should investors and consumers be thinking about the impact on Tesla?
So I think for Tesla, you're going to look at a couple things. One is pricing, but Elon Musk has shown an ability to be very flexible with pricing. He will be aggressive. He will pull back. Sometimes he's all over the map with pricing. I think with Tesla, the big concern for investors is what is their core model? Elon Musk hasn't been focused very much on building cars in the last probably 2 months. I think you want to figure out what are they? Are they a car company? Are they an AI company? Those are the big questions I have, because right now, obviously, Elon Musk seems quite distracted from the task at hand at Tesla.
Optimus wants to know if they're a humanoid robot company, Greg.
That's true. That's a cool one.
Thanks for watching. Stay tuned to Yahoo Finance for the latest financial news and updates.